Hey everyone, welcome back to another dividend investing video. If this happens to be your first time with us, welcome to our growing community of investors. We love dividend growth stocks here, especially when they're on sale. Today I'm going to share a few companies that I've been buying personally. They are stocks that pay stable dividends, they are growing these dividends every year, they are attractively valued, and they have a ton of potential upside. Each of these stocks is also currently priced below $40 per share. So let's get into it. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. Before we get into our list, I want to stress that the price of a stock does not in any way reflect an accurate measurement of the value of a company. If you take away one thing from this video, it's that a stock that is $10 a share can be more expensive than a stock that trades at $100 per share. This is a function of how many shares are outstanding versus the market cap. Companies can perform splits to manipulate the price of shares, but it doesn't change the underlying value of a company. But there are many reasons beyond this common misunderstanding why some investors like to focus on stocks that have lower share prices. By that I mean like $50 per share or lower. Many investors either don't use brokerages that offer fractional shares, or they prefer to only buy whole shares. An additional reason is investors want to write call options. In this case, you need to have 100 shares or the cash to acquire 100 shares, and stocks with lower share prices make that easier. This should only be done by experienced investors and really goes beyond the scope of what we talk about on a dividend growth investing YouTube channel. So today I put together a list of 3 dividend growth stocks that are priced under $40 per share at the time of publishing this video. And I think these stocks are all buys, and they're all stocks that I have been purchasing in the last couple months. And I plan to continue to build my positions. So let's get into it. And stick around until the end. I'll share one additional stock that I've been buying that's under $40. Not as cheap as the others I'm highlighting, but acquiring this one because I think it's a great long-term opportunity. Stock number 1 is UGI Corporation, ticker UGI. UGI is a gas utility with 3 segments to their business. They provide gas utilities to about 1 million customers in West Virginia and Pennsylvania. They're a propane distribution business in the US and Europe under their AmeriGas brand. And they also have some midstream assets such as pipelines, peaking plants, and storage facilities. With a market cap just below $6 billion, they are a mid-cap, and interestingly, they are America's first public utility holding company, as it was founded all the way back in 1882 in eastern Pennsylvania. Shares of UGI have been dropping huge year to date, down over 26%, and over the last 1 year period, shares are down about 30%. It's been a roller coaster over that last year. Shares dropped huge, but then mostly recovered, and then around the change of the year, they began to drop again, and they have not stopped. There's some cyclicality to this, and I like this one right now. UGI is trading at a PE of 8.7. This is 35% lower than its 5-year average, which is a great indicator of an undervalued company. Shares of UGI are yielding 5.35%, which is 69% above its 5-year average. And this is mainly due to how dramatically shares have dropped in the last year. Now, the dividend is paid out quarterly in the months of January, April, July, and October for UGI in the amount of 37.5 cents per share, and making the total annual payout $1.50 per share. The percentage of earnings paid out is 50% for the last 12 months and 47% for the next 12 months, comfortably below the 75% preference we have for utilities. Which really, with utilities, you can often see these hanging out in the 80s and 90% payout ratios, and that's pretty normal. I see no issue at all in the foreseeable future in regards to UGI being able to cover and grow this dividend payment. And Simply Safe Dividends gives us a safety score of 99, their highest possible score, and this was reaffirmed on May 18th, 2023, just a few days before making this video. UGI has been paying this dividend without reduction for 138 years, and for the last 35 they have been growing their dividend. If they were a large cap on the S&P 500, they would be considered a dividend aristocrat. But in my mind, they are a dividend aristocrat. The average annual dividend growth rate over the last 5 years is 8%, and I consider this really solid for a utility. The last increase was announced just a few days before publishing at 4.2%. a bit lower, but they have been coming off of particularly rough earnings, which is also a factor in the declining share price. But their revenues have been mostly steady over the last decade, pretty much expected for a utility. The $9.83 billion in sales in the last 12 months is a good increase over 10 years ago when it was $7.19 billion. And the average analyst price target for UGI is $40.40, which is a potential 44% upside from current prices. In my opinion, UGI is one of the better underrated utilities on the market. They provide a necessary service, but it is highly regulated. Just a couple months ago, they were required to lower their rates for their customers in Pennsylvania due to the drop in costs for natural gas, and customers got an 8% rate decrease. But there is a reliability to this business and its cash flows, and one does need to consider how they see the long-term outlook of natural gas and propane before taking out a position in a company like UGI. And for me, utilities make up the smallest part of my own portfolios. I target about 3 to 4%, and UGI is one of my favorites. I'm using this current weakness to average down on my own position here. All right, our second stock is Pfizer, ticker PFE. Pfizer is a multinational pharmaceutical and biotechnology corporation established way back in 1849 by a pair of German entrepreneurs. Today, they're headquartered in Manhattan, and they develop and produce medications and vaccines for immunology, oncology, cardiology, endocrinology, and neurology. I hope I said all those medical fields correct. Pfizer has been doing terribly year to date. Shares are down over 28%, and that's not even 5 months. Looking at the one-year chart, shares were around the $55 mark around December 15th, 2022, and it's just been downhill ever since. Today, we're sitting right around that 52-week low, and Pfizer currently has a forward PE ratio of 11.5, and that is a smidge below the 5-year average of 12.3. Shares of Pfizer are yielding 4.46%, and that's 22% above the 5-year average yield of 3.67%. So this could be a great time to lock in a high yield relative to what Pfizer typically does. And this is an extremely reliable dividend-paying company. They pay out every quarter in the months of March, June, September, and December in the amount of 41 cents per share for a total annual payout of $1.64. Pfizer's dividend makes up 51% of forward earnings and 56% of forward free cash flow. These are healthy-looking dividends in terms of payout ratios with no obvious red flags. Simply Safe Dividends assigns Pfizer with a dividend safety score of 75. It's considered safe and was reaffirmed on May 16, 2023 after the company's Q1 earnings release. Pfizer did end up cutting its dividend in the Great Recession of 2008, like many companies ended up doing, but this was actually due to a funding of an acquisition to increase their pipeline of new medications. So that's something to be aware of they have done before. But for the last 12 years, the dividend has been growing steadily and at a rate of 5% on average over the last 5 years. Shares outstanding have been on the decline over the last decade, going from 6.9 billion shares outstanding in 2013 to 5.73 billion shares outstanding today in 2023. No real buyback activity in the last 4 to 5 year period, however, and hopefully management reinstitutes that buyback program because shares are looking attractively valued right now from this point of view. And the price target for Pfizer shows a ton of potential upside, where the average analysts see this as a $47 stock, and that's 28% higher than where we are today. This is another one that has some cyclicality, and I like the stock as a reliable payer. It gives you opportunities to buy it from time to time, and right now it's looking good to me. I re-entered a position here in the last month. I like Pfizer below $40. Below 41, you're locking in a starting yield of 4%, and that's kind of how I see Pfizer. I mentioned in a previous video that I ended up taking some profits in Pfizer as I was settling my divorce to settle that, and I wanted to get back in, but when it was north of $40, I just simply saw way better opportunities for my investing funds. Today, around $36, I like it, and I'm going to continue rebuilding my position here when it's at this level. All right, stock number 3 is Bank of America, ticker BAC. B of A is one of the quote-unquote Big Four banking institutions in the United States, along with JP Morgan, Chase, Wells Fargo, and Citigroup. Bank of America is the second largest after JPM, accounting for nearly 11% of all American bank deposits. Its primary business is in commercial banking, wealth management, and investment banking. Year-to-date, shares of Bank of America are down 16%, like much of the banking industry, who have dropped over the banking failures that occurred earlier in the year. And over the last year, shares are down 18.4%, and shares are trading just a tad above its 52-week low. Bank of America is valued at a forward PE of 8.7, And this is a 22% discount to the company's 5-year average PE of 11.2. So Bank of America looks like a discount from this perspective. The dividend yield for Bank of America is at 3.13%. This is 42% above the 5-year average yield of 2.2%. Personally, my own position is added to when shares are above 3%. The dividend yield is paid out quarterly in the months of March, June, September, and December in the amount of 22 cents per share for a total annual payout of 88 cents. And they will be due to increase the dividend payment for the upcoming September payment. I'll be looking out for those details and we'll share those with you when that does become available. The dividend makes up 27% of forward earnings. And for banks, as long as this number is below 40%, we are happy. American banks have all kinds of regulations they have to follow, so this is something to keep in mind when investing in banks. Simply Safe Dividends gives Bank of America a borderline safe score of 55, and Simply Safe really puts the big four American banks all in this range, likely due to the increased regulations that could affect dividend policy and taking into account their dividend cut back in 2008. Now, but since that dividend cut, however, we have 13 years without a reduction and 9 years of dividend increases consecutive. And the dividend has been growing at a rate of 17% per year over the last 5 years. Bank of America has been buying back shares just about every year over the last decade, greatly decreasing the amount of shares outstanding over that time frame from 11.5 billion shares outstanding in 2013, and today in 2023, we have 8.16 billion shares outstanding. The analysts give Bank of America an average price target of 35.86, which represents nearly 28% upside from where shares are today. So another one that is ripe for recovery. I think out of all the big banks, I like where BAC is right now. And like Pfizer, I have re-entered my position that I sold out of for a good profit back in 2021. And I'm building it back up, basically as long as it's around that 3% yield or below the $30 range. Now, I want to stress again the unique risks associated with banks, but I do like the risk-reward proposition with Bank of America, and I think shares are at the best value they've been at since 2020. So these are 3 quality dividend stocks under $40, stable dividends, solid dividend growth, attractive valuation, and huge potential upside. And as promised, let me share one more dividend stock under $40 that I'm buying right now. That is Vici Properties, ticker VICI, and this is one that a lot of people are accumulating and are excited about. I wouldn't call it cheap, however. I think Vici is more at a fair value. It's probably a bit higher risk reward than the others as well. Today, shares are trading right at the midpoint between its 52-week high and low, and the price to adjusted funds from operations and dividend yield are both right in line with their 5-year average. Shares are yielding about 5% for Vici Properties. This is a newer company, so they don't have the track record of dividend growth that the others have as well. Vici is a real estate investment trust, and what they do is they own gaming and leisure properties. Much of their portfolio are the resorts along the Las Vegas Strip. And Vici is one of the hottest REITs in dividend and investing circles right now. Lots of appeal to owning a slice of these resorts because in many ways I think they are a bet on the American tourism economy itself. Now the average price target from the analysts on this one is $37.67. That's about 20% potential upside from where things stand today. Friends, thank you for sticking with us if you are still here. Please give that video a like for me and help us out with that algorithm. For full disclosure, I am long all 4 equities mentioned in this video: UGI, Pfizer, Bank of America, and Vici Properties. I'm also a longtime Bank of America customer, so I should probably disclose that as well. Now, if you want to support the channel, you can sign up for a free trial of Seeking Alpha Premium. The current deal is a 14-day free trial, which will give you plenty of time to check it out and see if their premium membership is a good fit for you. More to come in the coming days, so make sure you're subscribed so you don't miss out. Let me know down in the comments what dividend stocks are on your radar right now. I would love to get some more ideas for myself and to share with you guys. So until next time, keep investing.